to the Q&A that I have prepared, and you will hear more than once the answers to these with the caveat, like, this can change. And we used to think, man, until 2018, the last major tax law change was in 1986. More than 30 years between major tax law changes. And since 2018, it has been a ride, because we had the major tax law change, and then it seems like things are changing every couple of weeks since mid-March. So here we go. PPP, is it taxable? And how about the EIDL Advance, which was also called the EIDL Grant? Is that taxable? And the answers are no and yes, at least for now. And what I mean by that is, federally, no, they're not taxable. What an awesome stimulus program. They are not taxable. And yes, Minnesota, it is taxable for now. And there are big lobby groups that are trying to get the Minnesota legislature to conform to the federal changes. But at this point, for now, it's not taxable federal, and it is taxable to Minnesota. And the CPA profession is part of the lobbying efforts to get Minnesota to conform. But it's a big deal, and we don't know. The latest out of the legislature says that they think they're going to conform, but if anybody's learned anything this last year, it's don't believe anything till the ink is dry. And so this is it for now. And are local city and county grants taxable? There was a lot of stimulus effort on a local level, and the key word is grant versus loan. And yes, grants are taxable. The local city and county grants are taxable. If it was a loan, not taxable. Okay, PPP forgiveness. When there's a lot around forgiveness, many of you may have already applied for forgiveness, which is great, but there's still a lot of people out there that haven't applied for forgiveness. So what does that look like? And here are very common questions that we're getting on the forgiveness side. When do I need to apply for forgiveness? The answer is 10 months after your 24 weeks closed, which, if you don't know kind of what all that means, basically next August is when they're due, August or September. And we do recommend getting them done if you can now, but you don't have to. You can wait for August or September, or at least till after busy season when your tax professional maybe has a little more time on their hands. Is it complicated? Yes and no. Yes, if your loan was over $150,000, it is more complicated. It is more involved, and you need a little more documentation ahead of time. If your loan was under $150,000, no, it is not complicated. You need a couple numbers. Mostly the bank has it. You need your loan numbers. You need when you got the funds, and you verify that you use the funds appropriately. Where do I file the forgiveness application? So it's an SBA application, but everything goes through the bank that you got it with. Or if you got it online or whatever, that is who you're filing the application with. What do I need to prove that I used all the funds appropriately? So if we just back up and say, like, how was I supposed to use those funds again? Hopefully you know, and it all went right, but it was 60% has to be used on payroll, and the rest on mortgage interest, rent, and utilities that were used within the 8 or 24 week period. If you can qualify just on payroll in a 24 week period, we recommend just using that because it's easy. And you need to have, many of the banks are not requiring documentation like proof ahead of time, but our understanding is that if the SBA requests it at any point, we only have 72 hours to respond. And so it's a good idea just to have those payroll reports, your mortgage interest statements, your rent, your utilities, all of that documentation saved to a PPP forgiveness folder somewhere, so that if you are asked, you can respond promptly. And then we get this question, what happens if less than 100% of my loan was forgiven? And is the unforgiven part taxable? So a couple notes on that. Some people who qualified for forgiveness in the fall had their loan, the forgiveness piece reduced by their EIDL grant. And so they had a loan to the bank of up to $10,000 because of that grant. That was corrected with the December congressional action, and the banks are going back to the SBA to get that corrected so that it will be forgiven. But if you had a part of your loan because you weren't able to restore to full-time employees or something like that, it is not taxable. It actually is a loan, so that you'll have to pay back. So there's a lot there. And now, I'm sure most of you have heard PPP round 2. So I've heard there's another round of PPP. Tell me more. It's open until March. Applications are being accepted through March 31st or until funds run out. Funds ran out with the very, very first funding of PPP 1, but we don't really expect them to run out. But at the same time, it's like, well, don't wait. Just if you qualify, get your application in. So that begs the question, who qualifies? And just because you qualified last time doesn't mean you're going to qualify this time. This time comes with a lost revenue test. And the lost revenue test is a decrease in gross revenue. And I typed this out because I wanted everybody to be able to follow along. A decrease in gross revenue, that's very top line revenue before cost of goods sold, very top line. A decrease of 25% or more in one quarter of 2020 compared to the same quarter in 2019. And they must have received and used all of PPP 1 funds. So we've gotten the question, I don't have it written down, but we've gotten the question of like, well, for the whole year of 2020, I'm actually up compared to 2019, but I did have a quarter where I was down. Can I still apply? And the answer is yes, you can. Your whole year compared to 2020 to 2019, that is not the test. The bright line test here is just one quarter. So if you have a decrease of 25% in one quarter, you qualify, but only if you received round 1. So I'm going to jump my questions a little. It's like, okay, well, what if I didn't apply for round 1? Am I just out? And the good news here is that you're not out. Round 1 is still open. And round 1 did not come with the loss of revenue test. So you actually can apply for round 1. Now jumping back, does it matter? So for round 2 with the lost revenue test, does it matter if I'm like exactly at 25% or does it have to be like 30 or 40? And this is a bright line test. If you're at 25.0% of a loss in revenue, you qualify. And there's no extra judgment if you're right at 25% compared to 30 or 40 or 50. It is not scrutinized more. It is a bright line test. So you're in or you're out. And it's to prove that you have to have, we've done it a number of different ways. Certainly if you have a financial reporting system like QuickBooks, it's very easy. If you don't have that, we've used sales tax returns because they're on gross revenue. We've also just used bank deposits from one year compared to the next. And it seems that the banks and the SBA are accepting that as proof of the decrease in revenue. And moving on, my business is in the accommodation and food service industry, which we all know has been hit extra hard because of the mandated shutdowns. There are other industries that, like entertainment, that were also closed, and I'm not sure why they didn't meet this, but does it matter for this PPP round 2? And yes, it does. You actually get more. You get a 3.5 times average instead of a 2.5 time average, and we'll get to that. Do I need to apply for forgiveness for round 1 before applying for round 2? Nicely, the answer is no. We don't have to. Some banks are internally requiring it, and other banks are actually saying, no, don't even apply for forgiveness until we get round 2 in the door, just in case. So it's a little bit specific to the bank, but SBA says, no, you don't have to have qualified for forgiveness or applied for forgiveness before going to round 2. And lastly, and very importantly, where should I apply for round 1 or round 2? And we have had such a great experience all year working with the local banks. They have been great partners in this, and we've communicated a lot on our understanding of how to apply and what to use funds on and all of that. And I would give them a huge shout out and say, go apply at a local bank, because they've just been wonderful to work with. You cannot apply directly to the SBA. It has to go through a bank. So, okay, now I'm going to try to get through this, and bear with me. This is a little bit complicated of how is PPP round 1 and 2 calculated. So I did write this out so you could follow along, and I am just going to read it because it will be easier for everybody to understand. So 2.5. So to calculate how much PPP you qualify for, it's 2.5 times your monthly average eligible payroll costs. Seems pretty easy, right? Sort of. So the question is, well, what is considered eligible payroll? And it's not just wages. It is wages plus the employer contribution to retirement plus qualified health plan expenses plus state unemployment is your total eligible payroll. We divide that by 12 to get a monthly average, and we times it by 2.5, or 3.5 if you're applying for round 2 and you're in the accommodation and food service industry. And then there are a number of scenarios here too. Well, what if I'm a sole proprietor? I don't have payroll. I don't pay myself through a payroll service. I don't have a W-2. What do I use? And you would use your 2019 or your 2020 net Schedule C income, whichever is higher between the two. And then you add your retirement contributions, your self-employed health insurance, and likely you wouldn't have paid any state unemployment, and run through the same calculation. Another scenario is your business is a partnership and you have wages, but not for the partners, because partners can't have wages. What do we use? So you use the actual wages paid to your employees plus box 14 on the K1 from your partnership. So, and then you run it through the calculation, divide by 12 times 2.5. And if this all just makes you your eyes gloss over, you want to make sure you're partnering with your tax advisor, because they can help with this. And the banks, if you're going directly to the banks, they've been great, but they don't necessarily know that you have a partnership with something in box 14, and you could lose out on a good amount of PPP funding if you're not calculating it properly. So I'm a very big advocate of referring to your tax advisor. The stimulus money. And it came in May, and it came in December or January. So are these taxable or not? And the answer is no, they are not taxable, unequivocally. Do you need this information for your 2020 tax return? Yes, because you can receive more on your 2020 tax return if you didn't get the full amount. So one of the questions is, well, if I got more than I should have, because they used my 2018 return or they used my 2019 return, and my income is now higher, which, do I have to pay it back? And the answer is no, you don't have to pay it back if you receive too much, which is nice. The idea of this is to get money to stimulate the economy, to get money out there. So you don't have to pay it back if you receive too much. And then there's a handful of scenarios that we've been reviewing in our office, and it's really been a team approach because every situation is different. And we've been researching what happens, how do we claim these? And there's some funny situations out there. So in this first one, so the scenario is I claim my child every other year and claim the child in 2019. I received the stimulus money. What happens now? Do I have to pay that back? Because in 2020, I'm not claiming that child. The other parent is claiming. And the funny thing here is, no, it's not taxable. I don't have to pay it back. And the other parent also gets to claim the stimulus for the current year. So it's like that for that one child, there's 2 stimulus payments. And I don't know if that was intended, but it's out there and it's okay. And then we also ran into a situation where we have, hey, I'm soon to be divorced. We didn't qualify for the stimulus as a married couple, and we're filing separate this year. Can I claim the stimulus refund under 2020? And most of the time, a married filing separate return, you don't qualify for pretty much anything. But in this case, you do. You qualify as a married filing separate person based on yourself, your own income, and the dependents that you're claiming. And so unusual tax law is happening to stimulate the economy. And we believe it's working, but it's really interesting because it's not logical and it doesn't follow with what's been happening for 100 years in tax law. Okay, another interesting topic here is for all of you or any of you who had SBA debt relief. So you had a 7A loan, a 504, or a micro loan. And if you had one of those, you probably know what I'm talking about. And for those of you who don't, the SBA picked up 6 whole months of loan payments, principal and interest, and you didn't even have to apply for it. It was it just happened automatically. And I mean, that's just such an interesting stimulus package that was out there that a lot of people benefited from. So the SBA paid my loan payments for 6 months, principal and interest. Now what? And this has been something that's been a roller coaster. For a little while, we thought it was taxable, just like we thought the PPP was going to be taxable. And now it's turning out it's not taxable. And then the question is, well, can I deduct the interest that was paid? And the answer to that is probably not. It wasn't out of your pocket. The income, the money that the SBA paid is not income. So the interest is probably not deductible. And I'm saying probably because that's my understanding at the current moment. That could change tomorrow. But what we've seen is that there were banks and that sent out 1099 miscellaneous forms claiming that this money that was paid was taxable. And the most recent legislation changed that. So they stated it's not taxable. And if you received a 1099 miscellaneous from your bank that is under this debt relief, they do have to issue a corrected 1099. And so reach back out to the bank, and I'm assuming they know this and they're on it, but you want to just know that as well, that it's not taxable, it shouldn't be taxable, and you should get a corrected 1099 at some point. So we've covered a lot. There's still a little bit left. So my business received sick and family leave payroll credits. Now what? So for those of you maybe that don't even know what this is that under the FMLA, the Family Leave Act, they opened up this reimbursable sick and family leave. And really what the government was trying to do was get people to stay home if they were sick or showing signs of sickness or, and then on the other hand, people needed to stay home because of childcare problems, because their school was closed, their daycare was closed. And to take the burden off of the unemployment system, they put into place an employer credit for sick and family leave. So as an employer, I could pay an employee for 10 days for sick leave and have it 100% covered by the government. And for family leave, I was able to pay 2/3 and have that reimbursed by the government, all through payroll. And so now what, right? And are these taxable? And our current understanding is yes, these are taxable, basically by way of essentially reduction of the employment taxes. But we think they're going to show up on your tax return as other income. So you'll get to deduct all of your payroll taxes that you paid as an employer, and you pick up the other income, the credit that you got back. And if you're trying to self-prepare a return where you had these, it's probably a good year to reconsider that and thinking about using a professional to help. And the last note on here is, I didn't know these credits existed during the year. And we paid people while they were out sick to help them out. And now what? And the answer is tax returns really can always be amended. And in this case, they're payroll tax returns. And I would recommend amending to claim these credits because they can be significant. I've seen these credits upwards of, in the tens of thousands this year because they were encouraging employers to let people stay home if they were sick because to stop and slow the spread of COVID. So they are taxable. You can make a change. If you self-prepare payroll and want to make a change, you really should reach out to a professional and have them help with it. And you have 3 years to amend returns, so this can wait till summer. And I'm sure all of my tax professionals would agree that we would appreciate you waiting till summer. But don't forget, it is out there. And it can be very valuable as another stimulus opportunity. Okay, so we did talk. I did introduce sick and family leave, but I want to dive into it a little bit further to say, well, what qualifies as sick and family leave? Because this actually is still going on. So it was a 2020 issue. You can amend for 2020, and we can also claim for a self-employed person, which we'll also get into, on the 2020 tax return. So that's what we're getting into on this slide, is the self-employed piece of it. And it's there for 2020. It's going to be there for 2021, I believe, through March. There's a lot of dates and moving parts here, but I believe it's through March. It could possibly be extended through Q2 as well. So self-employed sick and family leave. So I was just talking about the employer portion of sick and family leave that happened through formal payroll. Well, I'm sure there are a lot of people out there that are self-employed that couldn't work because they were helping with distance learning or they were quarantining. And there's some pretty specific rules here, but I do think that there's an opportunity here on the 2020 tax return to claim some big credits for this. And again, if you're not working with a tax professional, you should be, because this is leaving, if you're not addressing this, you're leaving some big money on the table and you qualify. So we'll just kind of run through. I wanted to write these out because they're pretty specific on how you qualify. And I think most people should be able to qualify for one of these. So here we go. So sick leave. So this is for self-employed people, but also applies to the employer. So if you're listening as an employer, this is still around. You could still do this through payroll through March. But for the self-employed people, this is going to get picked up on your 2020 tax return. So sick leave. What is sick leave? Sick leave for a self-employed person is that a self-employed individual is unable to work or telework because the individual is subject to a federal, state, local quarantine or isolation, has been advised by a health care provider to self-quarantine, or is experiencing symptoms of COVID-19 and seeking a medical diagnosis. Based on my informal research, I feel like everyone could qualify for this. Like, there was a point in everybody's year that pretty much that you had to quarantine because you might have been exposed and or you were having symptoms, whether or not. So it does not require you to have had COVID. It just requires you to have needed to isolate because of it. So, and then sick leave you have up to 10 days or 2 work weeks, and it's calculated by your average daily self-employment income. So you take the higher of 2019 or 2020, likely it's 2019, and you're going to take your Schedule C net income divided by 260, which are the number of work days in a year. That gets you your daily average, and it is capped at $511 a day. And you times it by your number of sick days, and that equals your sick leave credit. And, as I said, this credit can be in the thousands, and we've seen it be in the thousands, and it's a big deal that really shouldn't be overlooked. And then there's the family leave piece, and that is where a self-employed individual is unable to work because they needed to care for an individual who is subject to 1, 2, or 3 above, or is caring for a child if the child's school or place of care has been closed, or the provider is unable to due to COVID precautions. So pretty much anyone that has a kid, I think, could qualify under this for at least some portion of 2020. And, the due diligence it has to be there. You have to have records of some sort. But I think if you kept a family calendar or really just have some sort of documentation, you will have done enough to kind of prove out that you're able to qualify for this. The one piece that I haven't been able to get a clear understanding on is, does the person that you're caring for need to be a minor child? The IRS makes it sound like you just need to be caring for another individual. But when I look deeper into it and when I dig into our tax software, it kind of seems like you have to have had a child to be able to qualify for it and have that be the person you're caring for. So as it comes up, we will be digging into it more. But make sure you're talking to your tax professional about it if you were unable to work or needed to quarantine. And where do I report these? I would talk to a tax professional and have them do it for you. But if you're doing it on your own, it is Form 7202. Okay, we got the question of red flags and audits. We hear about this all the time. Red flags and audits. What? Of course, I don't want to be audited. Who wants to be audited? And we get the question, what can I do to lower my risk of getting audited? And really, I'm not sure there's much you can do to lower your risk, but frankly, the risk of audit is so low anyways. The IRS is very overloaded with backlog tax returns, and 2020, they were all working remotely and got way, way behind. So, audits, there's a very slim chance, but I don't necessarily think there's anything you can do personally to reduce your risk. So what if you get audited? What should you do? I think you should talk to a tax professional and engage them if you self-prepared, and then start digging out all your documents. And the question we get a lot is, what documentation will I need if I get audited? And it's like pretty much everything. Make sure you have your receipts and your calendar and your mileage logs. And for the PPP and the stimulus and all of that, you want to just keep as good of records as possible. And And then you want a tax professional who is trained and has experience in working with IRS, because working with IRS, they are very intimidating. Their letters are very threatening. And frankly, like probably 8 out of 10 IRS letters we see are wrong. And they don't sound like they're going to be wrong, but that's why you want somebody that has experience dealing with them on your side. So my last slide in here is other 2020 and 2021 notables. So there are some other interesting things that have popped up this year that are stimulus driven and interesting that they can be picked up on your 2020 return or 2021. And I've highlighted a couple of them here. So a couple years ago, the IRS increased the standard deduction and pretty much eliminated taking itemized deductions for a lot of taxpayers. And itemized deductions is where the deduction for charitables lived. And so if we're not taking itemized deductions, we don't essentially get a deduction for charitable contributions. And in 2020, they passed a little rule, and this falls under the every little bit counts umbrella, that everybody that takes the standard deduction is allowed a charitable deduction of up to $300. So not huge, but every little bit counts. Maybe you can go out to lunch with the extra refund that you get there. For 2021 and 2022, this is super interesting and really was intended to support restaurants. And it was not clear to me if bars were included. It seemed to be food establishments that where for these next 2 years, we're allowed to take 100% meal deduction for meals. And, you know, a couple years ago, they re-clarified that, shored it up. They still don't allow an entertainment deduction, and they capped meals at a 50% deduction. Well, now to stimulate the restaurants, they are allowing 100% meal deduction, but it's food and beverage. So that's where it's like, okay, can bars be included in here? I don't know. Stay tuned. I assume yes, and maybe we have to back it out later. You still have to have a business intent for your meeting, to be able to deduct it in your business. But it's a pretty great thing, and go do that. One other thing that's out there is the employee retention credit. So now this is employers having payroll, and it's complicated. I felt like it was kind of outside of the scope of this Engage session, but I wanted to write it here and really encourage you guys to reach out to your tax professionals. It's a credit of up to 50% of your employees' wages up to $10,000. So you could be eligible for a $5,000 credit per employee if you were on a mandated shutdown, or you had a decrease of 50% of revenue in a quarter of 2020 compared to 2019, or, bear with me, 20% decrease in revenue in a quarter for 2021 compared to 2019. So again, this is pretty nuanced. You'd claim it on an amended tax return. Amended tax returns, we have 3 years to file, and we would love to help you with this. Probably not till May or June, but we are going back and we're going to be claiming these. This is going to be big money, especially for those mandated shutdown clients, and 50% decrease in revenue is really rough for those businesses. So we will be looking at this and going after it. And you should be working with a tax professional here to claim this credit. So have that in the back of your mind. And then my last two are just my plea. Expect more changes. And my plea and my warning, expect more changes. We are not done. Minnesota legislature has not opined on what they're going to do, meaning it's all taxable until it's not. Be patient with your tax professional. It is taking so much energy to keep up with all of this. And what that means is we are taking more time with each client because we don't want to miss anything. And there's big money to claim, but that the returns have to be done well, and we have to just be able to have time to think through it. We have gotten the question, like, will the tax filing season be extended? I have no idea. Maybe. It wouldn't surprise me if it was, but we don't know that at this point. And I will just throw this out there. I think the sooner people file, the more likely there will be changes on the return. So my note would be just go slow. Don't be in a hurry to file. The people that are in a hurry to file will likely have changes that will take time and will be painful to make. So, and the one thing that popped into my mind as I was talking was that I didn't include was unemployment this last year and the additional $600 federal unemployment bump. And is that taxable? And the answer is yes, it is taxable to federal and state. So you should be looking for 1099-G forms for those, and you should be including those in your tax return. So I am going to stop sharing and open the floor, if you will, for questions. You can ask me specific questions. You can ask me general questions, and I may not know the answer, but I will do my best at getting them. And if I don't have an answer, I will follow up, because there is a lot happening here, and I'm happy to find answers.
Does anybody have any questions for Katie at all?
Hi, this is Mary Wimmer. Thanks, Katie, for doing this for us. Yeah. So my daughter filed early because she always has to, but she had 2 weeks where she was off work because of COVID, and her employer does not pay her when she doesn't work. So I filed for unemployment for her for that 2 weeks. Would she also be eligible for this tax credit that you were talking about if she got unemployment?
The sick and family leave credit?
Yes.
So the sick and family leave credit is for self-employed people and employers. So it wouldn't have cost her employer any more to have paid her sick leave. They would have just had to have done an extra filing.
Yeah.
So they didn't, it was not mandated for small businesses, which were employers with less than 50 employees. So that's probably why they didn't do it. And that was great that you jumped on the unemployment. Make sure she included that on her tax return. The unemployment.
Okay. Yeah. Thank you.
Yeah, thank you. Good question. What else?
Katie, it's Mike. In your slide, excuse me, on the $300 standard deduction for charity that you can do, and then you had a little parenthesis said not in Minnesota. Is that?
Oh yeah. Yeah, that's another. Thank you for bringing that up. That is another piece that Minnesota has not opined on. They have not conformed, meaning that it is a deduction for federal, but it is not a deduction for Minnesota. So at this point, it's added back to your Minnesota income.
Okay.
Hopefully that'll be in the conformity, but we see that Minnesota historically has not conformed. They haven't conformed to 179. They haven't conformed to the $250 teacher education supply deduction. They just historically haven't conformed to federal. Just in sometime like in November, they did conform to a lot of it, which was the first time in a long time. And so I think that's why we're expecting them to conform here the coming month. But it's something like a $400 billion decision. And unless they proactively say they're going to conform, it's a benefit to the state, really, and a disservice to all of the businesses that got PPP and to the individuals who just want to take their $300 charitable contribution. All that's taxable in Minnesota. So if any of you have an extra few minutes, you can dial up your legislator and help us lobby. I'll gladly send you their information. That was great. Thank you. What else? Does anybody else have anything? And I will encourage my team even. Did I miss anything? Can you think of anything? I know there's a lot of you on here as well. Good.
I'll just add this is Mike Cordy from the Entrepreneur Fund, and I add a comment in regards to the SBA and on the free payments and things like that they were making, that they came out yesterday, the SBA did, with further rules and regulations on the payments going forward. Like loans going out now, we'll have 3 months of payments, and we thought it was going to be 6 months, but they don't have enough money to do that. So talk to your lenders about that if you have loans at SBA, because they are changing the rules daily.
Yeah. I will say too, this year has been very humbling from a knowledge standpoint. And, it's information was coming out faster than we had a chance to even read. And this most recent tax bill was something like 6,000 pages. So it has been humbling, and the answer's changing, like very often. And one of my staff team came and told me the other day, like, hey, did you know the EIDL Advance was taxable? I'm like, I don't think it is. And they're like, no, it is. Like, okay. And that's typically not how tax law has worked. And so it's been very humbling, and we've all learned to be flexible and to take that new information in stride and say, well, you know what? Yesterday that wasn't the answer, and today it is. And thank you for your patience, because that, so I know I speak for all tax professionals when I say thank you for your patience in helping us help you, because it's been a ride. So.
Awesome. Well, if anybody else has any questions for Katie after we end this session, you can either email them to me and I can forward them on to Katie, or if Katie, you want to drop your information in the chat again before you sign off, just so that everyone has it. But if no one else has any more questions, Katie, thank you so much for doing this. We really appreciate you coming on to do that. And again, this information will be on our website and our YouTube for your review. So if you know of anybody who had missed this session, it will be housed online as well. So again, thank you, and we look forward to answering any more questions you have and seeing you next month for Engage.
Yes, thank you so much, Kayla. I really appreciate the opportunity to present, and would be more than willing to follow up with any of you on specific questions or even general questions. I'm more than happy to help. Thank you.
Awesome. Thanks so much, Katie.
Take care, everyone. Bye.
You're kidding me.